of the Mortgage Charter. Rushanara.
Great. Well, good morning and thank you. So I wondered if you could quickly run through how much of an impact you expect the Mortgage Charter to have. Who would like to start? From the left.
Yeah.
Henry.
Be seen, I think, is the honest answer. So we saw a really high take-up rate of payment holidays during COVID. A different option, a different period as well. Put that into context, we saw over 25,000 people take a payment holiday in the first few days of the option being there in March 20. 100,000 in 2 weeks and over 200,000 over the duration of the availability of those options. So that kind of gives a bit of a benchmark. I think it's hard to fully say what the take-up rates will be. My personal view is it'll be lower than that. I think the key change that we're seeing, so actually perhaps put it into context, all the options in the Mortgage Charter are available today, including an interest-only concession, for example. The key change is those options, particularly interest-only concessions, will be available without affordability assessment and without an impact on credit file. So at the moment we see about 100 customers a month taking that option, but we know the credit file impact is a barrier to people taking that up. So that gives you kind of like the range that it could be. I think the important component that customers need to understand is that if they do take an interest-only concession for 6 months or they extend term, they will ultimately pay more interest.
It's cost a lot more.
So that's something that we're including within the application process for those options. And so probably the message from me would be really only take these options if you need to, because there will be a long-term cost.
Okay. And you were sorry. If everyone else could, if there are things you want to add to the point that Henry's made, that would be helpful. Andrew and Charlotte.
I was going to say, I think we welcome the Mortgage Charter. We think it's helpful for consumers and customers to have a clear idea of what banks will offer them. And I think this provides that. Similarly to Henry, we provide a number of these options for customers already. So I mentioned the opportunity to fix 6 months before maturity. But it does provide consumers and customers with a deal of clarity on what they can do and can expect from their lenders.
It's a build on that point. So I think in terms of level of take-up and customers seeking those options, yes, remains to be seen. And to Henry's point, I would also expect that will be lower than what we saw with payment deferrals during the pandemic. I think, touching on one of your points, Andrew, around customer certainty, it is a different environment that we're in today. There was very little certainty during COVID around what that meant for finances, what it meant for employment and work, and what customers understand now is what that certainty of payment might look like over the next 12, 24 months, and the options available. So I would expect it to be lower, but we're also equally preparing for customer inquiries coming to us.
Bradley and Nigel, did you have anything to add to those points?
Just one point to add would be what we've seen most recently, and it's a point that Henry raised, is customers who have a mortgage product that's expiring over the last few months. Less than 4% of those customers are inquiring about a mortgage charter type solution, obviously pre-mortgage charter, but a term extension or a conversion of their mortgage to help affordability. So again, to Henry's point, we would expect the numbers to be lower than the pandemic in terms of the payment holiday situation. But again, yet
more likely to extend terms, the length of the repayment.
Yeah, I mean, I think it would depend on the customer circumstances, and what we would encourage customers to do is to contact us as lenders to talk through those options and understand all the options before they decide, because if a customer can afford the increased payments, then longer term it's better for them because they'll pay less interest, of course.
Nigel, anything to add?
Yeah, the Mortgage Charter, we're a specialist buy-to-let lender, but the Mortgage Charter does not apply to buy-to-let. However, we are following the Charter itself, and we would be very happy to sign the Charter if we were required to.
I mean, should you be included? Because the evidence suggests that it affects there's distress in that sector as well.
Yeah, so I mean, I don't know why buy-to-let was excluded, but we're very happy to sign the charter.
Could I make a comment on that, please? Sorry. I mean, the options around extending term or moving to interest only, a high proportion of buy-to-let customers are already on interest only, so those options don't really apply in that situation. I should also mention
the length of extension. Sorry, the extension, does it apply to, they can already
make
do
a
that?
difference to an interest only mortgage either.
Okay.
I should have mentioned that we already offer the option for customers to extend term out to retirement. We see between 800 and 1,000 of those applications per month. That doesn't have an impact on credit file, no affordability. So perhaps a benchmark of that sort of take-up going forward.
So what is the point of the mortgage charter then, if you're already doing much of what's written up? Is it that just people know a bit more about where they stand and it's in one place? Has the Chancellor added anything in substantive terms by coming up with this mortgage charter?
Oh, sorry. I think it provides consumers and customers with clarity around what's out there and consistency. So different lenders would have had different approaches. So I think it does that. I also think that inflation is still high, so there's still the ongoing squeeze for customers and consumers. So I think it's helpful intervention if things as things progress.
So 85% of the market is covered by this voluntary charter, according to one report. There's 15% who are not. Do you have a view on whether the government should reach out to them and encourage them or kind of try and influence them to sign up to this charter? I think these are those it would be appropriate for them to sign up, given you think it's quite a good thing. Anyone?
I think each lender will have its own reasons if they aren't signing to the charter, and it may be, to Nigel's point of being about a specialist lender. I don't know. Just from a Santander perspective, we're supporting the charter and signing up.
Okay, and so what we know in terms of overall figures is that we're going to see 1.4 million households that are set to roll off fixed rates over the course of this year. And as the chair has said, most of them have 2 to 5 year, 2 years, up to 5 years ago, and we're on much lower rates. So we are going to see much more stress in the system. Do you think? What do you think you could be doing above and beyond what's there in the mortgage charter and what you've been doing to try and minimise the risk of repossessions or distress, even if they don't face repossession? It's going to cause a huge amount of financial distress if your mortgage, average mortgage in London is going to be go up by over 5,500. Nationally, it's just under 3,000. Have you got a view on what more banks can do? Andrew?
If I outline the way we've thought about it and what we're doing, that might help with some context in the way that we're thinking about approaching this. So there's largely three groups of customers. There's those customers that are coming off fixed rates, and for those customers, we allow them to select a product 6 months before that maturity again. So that allows, as I said before, that allows them to plan. We've also looked at within there what customers are at potentially high risk, and we've phoned those customers to not only allow them to lock in, but also to an extend term if they need to. So that's on that group of customers rolling off those fixed term products. So we're trying to help those customers, and for those most at risk, we are proactively reaching out to them. Then there's a group of customers on variable rate products. So for those customers, every single customer gets at least one communication a year that tells them what the product's available. If you can make a saving at all, we'll send you another communication and tell you can make a saving by moving to a different product. So for example, if you could save £100 a month, we'll say you can save up to £100 a month. So we're really explicit in that communication. And again, for those customers who think are at most risk of cost of living, we do outbound calling. And we've called 35,000 customers to let them know that there is the potential for another product to move to. And then finally, there are customers in financial difficulties, and we've got a suite of tailored forbearance activities for those customers to try and keep people in their homes and only use repossession as a last resort.
Does anyone else want to add?
Yes,
Nigel?
just an additional point is we use quite an extensive suite of early warning indicators.
Yep.
So if you wait until a customer has not paid, then our view is always try and anticipate that and deal with it early. Mm-hmm. So we use everything from obviously listening to reaching out to customers in a similar way as described by Andrew, but also we use a lot of quite smart technology to try and identify early signs of stress in an individual's life that may not be evident yet in their payment performance. And if we do see that, we reach out to the customer and try and understand the issue and then offer help where it's needed.
Just finally, do any of you know about mortgage prisoners and what the implication of the rising interest rates are going to be for them? Do you have people who are trapped in the mortgage prisoner kind of category? And also, how do you have a view on the fact that the extension of mortgages or the break, if you like, does mean that the overall cost burden will be pushed back to later on in life? And then what are your thoughts on that? Because people are still going to be worse off. It's just about deferring the pain, if you like. Any thoughts on either of those points?
Pick up the second point. So people extending term now, for example, to manage their payments. When they come to renew their product in the future, it may be that the rates have reduced at that point. As part of the product switch journey that we have, we encourage people to review their term again then. So at that point, when rates have come down, potentially they can reduce down their term and therefore reduce the total amount of interest they pay.
They'll still be worse off than...
They'd have incurred more interest during that initial period, but the earlier they do that, the less that they
Any other comments on either of those points?
Just on the mortgage prisoner front, from a Santander perspective, we offer rates to all our customers. So there's no customers. It's similar to Andrew in terms of the contact strategy for customers on variable rates, so that they are aware of other products that they can fix onto if that's what they prefer. We have 90% of our customers at the moment in fixed rates and only 10% in variable.
And the affordability changes that we push for in this committee from absolute to relative tests for those who are trapped in as mortgage prisoners, have you used that as you've done the assessments?
So I know there's a second piece of work underway at UK Finance to look at mortgage prisoners, and particularly to try and understand the data better from those closed book lenders, so we can tailor our approaches, and that work is ongoing currently with UK Finance.
You do know that I've been campaigning on this for years. In this committee, the FCA had revised the guidance from an absolute test to a relative test of affordability. We were assured that things would then change and people would be able to have access to mortgages and favourable rates and be able to switch, and it seems very slow, the work that's got underway. One of you is on the FCA board to get this going, and now people are stuck in this situation with rising interest rates, so it's going to be even worse for them. Can we have some urgency, please?
Just to comment, we have no mortgage prisoners on our portfolio. Every customer can get a front book rate, and we have adjusted our affordability for mortgage prisoners. We see very little coming through. But when we looked at it previously, we did see that there were a number of customers applying to us from closed book lenders, but not necessarily categorising themselves as mortgage prisoners.
Thank you very much.
Thank you. Just in